Well, ladies and gentlemen, welcome back to our final debate. I can't remember how many conferences, all-day conferences I've been to, but you are to be congratulated on your stamina and your presence, so thank you very much indeed for your attention. This debate coming up, I think, is incredibly important because although we call ourselves the Quoted Companies Alliance, it isn't all just about equity. It's widely recognised that there's a finance gap for mid-cap companies. The Department of Business, Innovation and Skills has recognised this in their growth review, and the CBI have done a very interesting report on mid-caps as well, which I commend to you, which they issued, I think it was last October. In this session, we're going to explore the financing options available to small and mid-cap companies, everything from traditional bank debt to equity to listed debt and more, and whether we need more funding options. I'd like to welcome the chairman of this panel, Michael Higgins, chairman of Ebiquity plc, and also deputy chairman of the Quoted Companies Alliance, who will introduce you to the rest of the panel. Michael.
Good afternoon, everybody. As Tim has just said, I'm delighted to see that the dropout rate is substantially less than one normally sees in these conferences by this stage. I'm sure it's just because you're waiting for the European session starting at 4 o'clock or 4:30. If I can just introduce the panel on my left, I have John Kent, who's the Deputy Chief Executive of the City of London Group plc, whose strategy is to build a financial services group centred on specialist financing and alternative fund management, and clearly has a unique perspective as not just a provider of funding, but as a Deputy Chief Executive of a small cap company himself. To his left is Ross Taylor, a relationship director from Barclays Bank, who manages relationships in the sort of manufacturing, transport and logistics sector. His first version of his CV I saw had him down as previously being a professional rugby player. Apparently he doesn't like that too widely disseminated. He claims it was down to injury rather than size that stopped him continuing playing for Newcastle and Sale. I then have Marcus Stuttard further on my left, who's head of AIM and has responsibility for primary markets in the UK across both AIM and the main market. From my perspective, is now famous as the only person who's actually quoted back at me something I once said at a dinner, maybe because he was the only one polite enough to listen. We're going to give each panelist sort of 10 minutes, and beforehand, maybe I'd like to make a sort of few comments. The subject matter is vast and huge, as Tim has indicated, but we will try and, I think, touch on, or at least raise issues through these presentations to answer sort of the four key questions, which is what financing alternatives exist for small and mid-cap companies. The question, is there a need for alternatives? Why don't small and mid-cap companies issue debt? And is there a finance gap for small and mid-cap companies? And I think we probably agree that the answer to the final one is yes. There's certainly a need and a gap. The extent to which it can be bridged by the earlier questions, we'll see. Some observations from my perspective. I mean, in the mid-80s, I used to advise a number of what were then small mid-cap companies in the 50 to 100 million pound bracket. And there was one particular company whose capital structure you'd never see today. It had traditional ordinary shares, convertible preference shares, at least more than one class. It had non-convertible, redeemable preference shares. I think in that case they were also voting. It had convertible loan stock. It had conventional bank debt as well as asset-based financing. You would never see that structure today, but all those instruments are just as valid today as they were then. It also, by the way, used to have an ADR facility in the US, and it had both US and Canadian banks providing finance. And this was a company in those days making probably only 10 to 12 million pounds of EBITDA. It wasn't probably a great corporate success story, but it shows you that generally all these alternatives have existed, and we don't actually have to invent anything new, we just actually have to reinvent the past. The other point that's worthy of note is that ultimately, when one's looking and considering all these various instruments, fundamentally they will either be in the category of equity with some variant, or they'll be debt. And certainly when looking at the capacity of companies to actually take on these alternatives, the fundamental capacity to take on debt will not change. And therefore, and I was just talking to the other panelists before we came out, in a conversation with one firm of brokers earlier this year, they pointed out to me that institutions, when they looked at companies, were really quite precise about what was acceptable levels of debt. If you leveraged yourself to 2 times EBITDA, that was probably 2 points off your multiple. And at 1 times EBITDA, you were fine, and at 1.5 times, they were watching you closely. So whatever you actually consider as alternatives, you need to be mindful that debt capacity fundamentally doesn't change. In terms of one particular alternative, and I was scanning the room to see whether one of our former chairmen has, oh, he's still there, Donald, you asked a question about pipes, which I'm not sure is going to be addressed by any of the others, but I'll just make some comments having looked into it in some depth some years ago. One of the problems we have is that the pipe as used in the US is not the same definition that was widely used around the market in the UK. A pipe in the US is really a form of deferred conventional ordinary equity. A pipe as used in the UK was used as a shorthand for the introduction of getting private equity or development capital money into public companies. And a number were done. Relatively few, and but they have a fundamentally different characteristic to those that were used in the US. Here they were looking for board involvement, they were looking for much more operational involvement with the company akin to a private equity investment. And some of you may remember that 3i launched a specialist fund for this, which was rather short-lived. And if 3i can't actually manage in those days, when they had quite a collection of public company investments, to create a pipe fund effectively, then one has to question the ability of private equity to actually get money into public companies. I then should caveat the fact that I have a private equity company that owns effectively 45% of the company I'm chairman of, which was part of the way of buying a business when the rest of the market would not support effectively an acquisition doubling the size of the business. One question that I sort of would like to hear on as we go through the panel is the question as to whether, if we do create alternatives and alternative sources of funding, it actually increases the problem of illiquidity in the equity markets that we already have by spreading effectively opportunity into yet another illiquid stock or a liquid investment for others, as opposed to actually finding the opportunity to get greater breadth in the standard investment instruments of equity. I don't know the answer, but clearly if there is a funding gap, we don't want to make it worse for ourselves rather than better. Fundamentally, and this is one of the driving forces, as Tim's indicated, of the QCA, we are here to try and find ways of ensuring we have vibrant, liquid capital markets for our stock. And as we consider alternatives, we have to make sure that those are not acting in conflict. The other point is that we do need to restore the pipeline of quality companies that are coming through to the market. I think the point that I think Judith made in the last panel about singling out particular failures, there are always going to be the odd rogue company that gets through. Fundamentally, the vast proportion of companies that make it to the market are high quality, good companies with good prospects. And therefore, it's making sure that those companies are applauded and create an example for private companies that should aspire to now becoming public companies. On that basis, I will now ask John, you're first up, to talk to us a bit about his view on alternative sources of finance.
Thank you, Michael, and good afternoon, ladies and gentlemen. I'd rather hope, this being the last slot, that you would have solved the question already of how to get engineer growth in small companies. I'm not sure I bring any answers to that, more a journey of a small company. The City of London is an investment company. It's in the small cap bracket, 10 to 20 million, main market listed. we have as our business activities basically a focus on financing the SME market and the professional market. We do that by really looking at niche activities, particularly trade finance, asset-backed lending, and lending to professional firms. And we do that through an asset management approach, i.e. we don't seek to grow our own balance sheet, we seek to establish funds through which we then finance our customers. However, we are small and our customers are small, so what I present is a journey of both our clients and ourselves in this rather difficult market. I'm not sure that you really need to have me repeating gloom and doom. Presumably that's already been emphasized today. I mean, one thing I will say is that there's nothing that's happened, not the latest Osborne pronouncement, that's changed our view, my view at least, that we're still awash in a sea of indecision. And we're sitting there facing GDP forecasts for the Eurozone, which are going downwards for all the northern European economies and going negative for the southern European economies. And banking, of course, and I'm very wary about saying too much about banking, given that I have a second row rugby football player beside me. Banking is exacerbating the problem. So not only is there a problem with the general economies, but I think the banks have also, for good reasons, reined in their horns. For us, that's an opportunity. I can't help but think that sort of there is this great schizophrenia on behalf of the government, where it's seeking to encourage lending from the banks, Project Merlin, all the Osborne measures, and at the same time, the regulators are seeking to encourage retrenchment. So the consequence is, I think, some paralysis. Certainly, we see it amongst our customers, and we experience it ourselves. And the Breeden report, which you'll be aware of, did note the fact that the UK has the highest rate of rejected SME loan applications in Europe. So the question was, is there a need for alternatives? Yes. The Breeden report estimated a funding gap of 84 to 191 billion for business at large. The SME side of that is 26 to 59 billion through to 2016. And if anybody's old enough, they'll remember Harold Wilson's famous financing gap for small businesses 30 to 40 years ago. I'm sure statistically, if you inflated it, it would probably come out to the same number. So I don't know that it's a new problem, but it's certainly one which we're feeling the worst of right now. And there's the evidence of what's happening to lending at the moment from the Bank of England. Again, personally, I'm quite confused by some of these Merlin statements which say that actually bank lending is increasing or more or less flat against what anecdotally we receive from our client base. So what immediate alternatives exist? And again, using the Breeden review has been quite instructive, because many of the solutions that were proposed and talked about were in some ways changing the whole nature of the market. So, for example, invoice discounting, which is widely accepted in the US, is hardly used at all here, mainly because companies feel that their clients will regard them as shaky or about to fall over. But to change that cultural approach is a matter of a number of years. So although there are these theoretical opportunities for improving cash flow down at the smaller end of the market, actually they're difficult to access. So we find, obviously, that actually most of the routes proposed by Breeden aren't immediately available. The old market for retail bonds, the smallest company that actually issued bonds there was 25 million by Provident Financial, market cap about $1 billion. And debt issues for small caps really are still, in our view, regarded by institutions as much the same risk as equity issues. And from the point of view of the small caps themselves, they're incredibly laborious to go through and not an easy way to raise money. I had to get a little dig in on the IFAs at the end there, because trying to sell a bond to an IFA is almost impossible unless your name begins with British and your second name is Telecom or National Grid, but it's not one for small caps or medium caps. That, though, does present an opportunity, and there is a real opportunity here to change the way in which we approach financing debt. And the way we're trying to do it at the City of London Group is really to tap the retail and institutional investor base and seek to attract them into funds which are effectively debt providers. We also have, of course, the new banks which are providing an alternative, and I'll come back to them. But in tackling all of that, we have still a bit of a mountain to climb. We have scale. An institution won't think of much beneath 50 million. We have the whole issue of how we distribute that debt either to institutions or to retail investors, the cost of doing so. There is also clearly along the line a question mark about whether non-bank lenders should begin to experience the sort of regulation that banks experience. Risk appetite amongst institutional investors, and that's really linked to understanding the SME asset class. This isn't a charitable thing. There is a very good return to be made on extremely widely diversified assets. And if you look at the bad debt records for the small to medium-sized enterprise market, actually they're pretty well established, and they're not as enormous as some people might think. We run our leasing book on the assumption that our bad debts will be 2% or less. And if you look at the Finance and Leasing Association statistics, it's actually around about 1.5% to 2% over the last 2 economic cycles. So it's not in itself such a risky proposition. What's difficult is actually to get the institutional and retail base to understand that. So where are we actually looking? If we don't see any immediate alternatives, where are we looking for medium-term alternatives? And we've actually ourselves started going into some nooks and crannies which are less than industrialized. There's the peer-to-peer lending and online exchanges, which are tiny at the moment. Funding Circle, I think, has lent something in the region of 35 million in a year and a half. Doesn't make much of a dent against the 29 billion target, but they are growing, and I think sort of we would look with some interest on how they grow and whether they can actually maintain a reasonable credit risk assessment as they grow. The new banks are quite keen to get into the major bank space. Partly they're focusing on the consumer from our point of view, but they can see the SME class as one which is now worthy of, and also a means of, deploying assets quickly. The Aldermoors, Secure Trust, Metro Bank are all capable through some of the aggregated sites of raising 200 to 500 million relatively quickly on relatively good rates from the retail customer base. Their issue is how to deploy it. So from our point of view, they are potentially good wholesale customers. And then, as we've talked about, there's active professional investors, and by that one means family offices, hedge funds with surplus cash. Our major successes, to be honest, are we've just done a large financing deal with Macquarie, an Australian bank. We are midway through doing a deal with a Swiss investor. We have a number of funds out with high net worth investors, and another fund we just had finances through a special opportunities fund. They're all nooks and crannies and what I'd call bantamweights. The major difference for the sector will come from the heavyweights. And of those, I mean, we are in discussions with all of them, but of those, I think the most promising from our perspective is the life funds, who have shown a very definite interest in getting into this vacant space, not completely vacated by the banks, but certainly there's an opportunity there. They struggle with maturities. So, for example, either they are keeping a liquid allocation or they're trying to get 15, 20-year money. Doesn't suit an asset which is on a 4 or 5 year life. So there's a mismatch there, but there is certainly an intent to get there, and the participation of some of the life funds with the government, the Treasury and BIS, suggests that they will become, and obviously there are people like M&G who've really led the way, suggest they could become more active. So we've actually, as a business, survived and grown through going into what I call the bantam market, the nooks and crannies. But we don't actually see the market at large changing unless some of the heavyweights play a bigger part. And there are a number of ways to do that, which no doubt we can discuss. Thank you.
Thank you, John. Ross, your turn.
Good afternoon. Very pleased to be asked to speak here today to give a few thoughts from a banker's perspective on how we can collectively as an industry, but obviously within Barclays as well, support sources of funding for SME and mid-market businesses and their growth. I'll focus on traditional corporate lending, at the risk of being a little bit too simple, going back to basics, which I find always works for me personally, as well as less traditional financing alternatives, and hopefully leave a more positive message of how banks view the SME and mid-market than perhaps you might otherwise be led to believe. So at the risk of oversimplifying matters, I thought I'd go real back to basics and just take a look at what banks are there to actually do. Fundamentally, banks pull together depositors' money and then through maturity transformation, turn that money into loans for clients. We create the opportunities for people to borrow each other's money. The use of loans generally is for working capital purposes or for the purchase of assets, one form or another, acquisitions, capital equipment, various other assets within any business. And importantly, from a bank's perspective, there's no equity upside to the loans that we make. We're in it for the interest return, and therefore the risk-reward balance has to bear that in mind when we're considering any loan application. The risks taken should be commensurate with the return on any loan that we make. And fundamentally, bank loans are not a substitute for equity. It's one of the first things that we look at, particularly for early stage businesses or those with a less mature capital structure. Banks provide other services to our customers. Importantly, a large portion of our customers don't need to borrow from us at all, but certainly need to make use of our geographic footprint, network and systems to enable them to run their business on a day-to-day basis. In line with this, the ancillary business that we pick up from our clients is absolutely essential and is becoming more so. We'll come on to the reasons for why later. But that acts to support the capital commitments that the banks make. And certainly within Barclays, there's a number of cases where the justification for committing balance sheet is made by the wider business that we do with our clients. Capital commitments on their own are only marginally profitable in a number of cases, particularly in the current environment. Product innovation and market development is something that we try hard at. It's debatable, I'm sure I'll get views on whether we're successful at that. But we do try also to act as facilitators where we're not able to help, or perhaps the appetite is full to find alternative sources of finance elsewhere. There have been issues, of course, for banks in fulfilling their role in the economy, increasing regulatory burdens, including Basel III, and those rules necessitate greater capital reserves within our business, funding and liquidity than perhaps has been the case in the past. That's changed the way that we have to view our business and the paradox of pressure to lend on one hand whilst at the same time being required to hold more capital is a balance that the market is struggling to come to terms with. Once we add in higher wholesale funding market costs due to market reaction to the economic turmoil, particularly around the Eurozone at the moment, retrenchment of overseas banks and a shrinking in the number of market participants, and significantly falls in demand from our customer base who are looking to reduce leverage to lower levels than has been the case in the past. Pose challenges in why banks may face problems in hitting their own lending targets as well as those presented by the government, and also why our clients may be reluctant in coming to us for borrowing. Fortunately, in the case of Barclays, here's the sales piece. We're absolutely rock solid on capital. We're out in the market. We're looking to grow our business, and our customers are responding well to that approach. So on some financing alternatives available through the life of a corporate's capital structure development. Of course, all companies need to start with some form of seed equity. This is a bit of a complicated slide, but it represents some of the, what we would view as traditional financing alternatives as a business grows and its capital structure develops. In the initial equity funding stage, unfortunately, despite lots of good intentions on the part of bankers to try and help, the risk-reward in providing significant debt facilities falls outside of banks being able to provide significant support. The risk-reward just isn't there. Growth, profit, and hopefully cash flow follow, and that enables us to provide increasing levels of debt, which reduces the overall cost of capital through time. Further growth then hopefully ensues. That can lead to capacity constraints within bilateral banking relationships. That's the point at which we look to bring some other banks into our lending transactions. Once the syndicated facilities are full, movements through other sources of finance, and banks can play a facilitation role in providing access, for example, to institutional funds through US private placements, public bonds, convertible bonds, and so forth, until we eventually get to the point where the debt appetite within any business is so soaked that it needs to go back to the start and raise more equity. Again, we try and provide and facilitate for that need for our larger clients. Interestingly, as the diversification needs increase, the need for ratings and all sorts of wider considerations come onto the table, and businesses have a decision to make as to what route they want to take, particularly in relation to ratings. Importantly, from our side, when dealing with public companies, the need to retain access to equity is paramount, particularly if it needs to be raised on in a short time scale, and of course, shareholder support to achieve this is essential. Looking at a few of the debt financing alternatives which we provide to our clients on a regular basis through our investment bank primarily. Bank debt obviously is the piece which gets a lot of attention. We typically find, and of course these are just broad guidelines, but the bank market in the UK can carry up to around 750 million of debt. Maturities vary from 1 year on demand facilities through to committed 3 or 5 year facilities. Covenants usually come into play, and that, of course, is a hot topic for debate. In terms of complexity, it's probably the simplest route to accessing additional financing. The US private placement market is something that we've gone to with a lot of clients over the last couple of years, much more so than we did in the past. There is a great deal of liquidity in the States, and we try to tap that for our clients. Of course, USPP investors want a higher return, given the nature of their commitments and the controls they have around providing that debt. And of course, clients need to wrangle with that balance before they commit to going down the route of getting a rating and trying to tap that liquidity pool. Public bonds and convertibles become increasingly equity-like in their makeup, and of course, because of that, the cost goes up as you go down that route. So what do banks look for when we first receive a request for either new lending or an increase or even a refinance? Over the last few years, the basic fundamentals of what bankers look for in providing loans hasn't changed. Banks are in business to lend money. I liken it in my sector coverage of manufacturing to turning the machines off. It just doesn't come into the consciousness not to lend money. Banks are out there every day trying to do it. It is true to say that how we lend money and the risks taken have changed somewhat, but fundamentally the bank market remains open to all credible borrowers. So if we look at the two broad churches of the use of funds, firstly working capital funding. Of course, typically this is going to be on overdraft and sales finance. An interesting note around the attitude towards invoice finance or sales finance. We as bankers like it. It's an interesting one. There is a perception issue, but it's one we get through pretty quickly when we can demonstrate the type of borrowers who are utilising these facilities and the reality of lower cost of funding should they choose to do it. The main issue we find with invoice financing, as opposed to perhaps more flexible financing structures, is the additional burden of administration in running the facilities. That's something we try to help our clients with. Also, invoice discounting enables us to stretch the envelope of how much we can lend to our clients. The loans that we make through a working capital facility are repaid through the cash conversion cycle, not from the business's own cash generation. And of course, if we were to turn the machines off, we would hope that the repayment comes from the collection of the eventual debtors, not from any future profitability. The other type of funding, broadly asset purchase funding, committed, long-term, and fundamentally different from working capital in that the repayment comes from future profits and cash flow. It's an important distinction to make because quite often the use of funds is an absolute fundamental when looking at any lending application. Assets may include plant and equipment, acquisitions or property. And the key issue for us is assessment of cash flow. Can this business withstand any stresses going forwards to generate enough cash to repay the principal and interest? As such, cash flow from the business, not just EBITDA, is where we focus our attention. Security in these instances, of course, is a very secondary consideration, and frankly, for public borrowers, is something that is a long way down the list of priorities. Most importantly is how the business has performed. Does it have contracted revenues that we can lend comfortably against? So on to the bulk of the subject matter, which is alternative sources of finance. This is an interesting area. When asked what are the alternatives, there's a lot, particularly in the sectors that we look at. Trade finance is a growing area, particularly for Barclays. And we can use instruments that are based around documentation in a much more structured fashion than standard overdraft facilities to extend payment periods, secure transactions, and improve liquidity for our clients. Supplier finance is another hot topic at the moment, very much being rolled out as a competitive area within the UK and European market, and that allows suppliers to benefit from the credit strength of their large customers. It works for people, and of course reduces the need for them to raise the finance themselves and more than likely pay a significant premium using their own risk profile. Credit cards and purchasing cards is an area that is in development, again more mature in the US, but certainly purchasing cards and payable solutions allows buyers to negotiate early settlement terms whilst at the same time extending their debtor period in effect in exchange for a small fee. So businesses focused on liquidity, it's a really strong solution and one that we're very much championing. Government schemes and loan guarantee schemes are very much on the agenda as well. Barclays works closely with government to ensure we play our full part in providing these schemes. So in summary, the bank market, I would argue, is open for business. Barclays certainly is. We're actively seeking to grow and develop the alternatives we offer to our wide and varied customer base. If you're going to the bank, you need to be absolutely clear about the role bank funding is going to play in your organisation and its capital development. You should be demanding of your bankers, get them to offer you alternatives and press them for information. That will help you plan and develop your funding strategies, even if traditional debt funding is not immediately available. Thank you for listening.
Thank you, Ross. I'll resist the temptation to ask any questions now. Marcus.
Well, good afternoon. And I'd like to just echo Michael's congratulations on you all still being here, and also congratulations to the QCA for bringing you all together, because this is undoubtedly a really important topic, engineering growth. I'm assuming that because you've all been here for most of the day, I don't have to start from the basics of explaining why small caps and smaller quoted companies are really important. as read that you all understand that they are the engines of growth, employment, innovation. So the subject of this panel, is there an equity gap? Well, I can absolutely confidently say that we don't have an equity gap or a funding gap in either the UK or Europe. And what's more, it really worries me when academics and policymakers, researchers, set out repeatedly to try and find out where the equity gap is or the funding gap and what its size is. I'm absolutely convinced that we have at least 3 funding gaps, and they start at various stages in the funding ladder. And I think that's a really important kind of context and an important starting point. So, we've seen in the last presentation a flow diagram showing different forms of finance. At the end of the last panel, Andrew Buchanan made the comment about a real need for management teams and entrepreneurs to be aspirational and to stop thinking and having a mindset of let's set up a company so that we can sell it. And that's where, in particular, I think the equity markets and markets like AIM are absolutely crucial. So if we look at the equity gaps or the funding gaps that exist, what I believe is that at the different stages of companies' development, there are gaps where one set of investors pass over to the next set of investors. So, for instance, where business angels or friends and family pass over to the banks and then the venture capitalists and then the public market investors. And so, as a result of that, policy has to focus not just on one area, but on multiple areas, which is why I think initiatives like CDIS, the extension of EIS, the state aid approval for EIS and VCT schemes is really very welcome. And I think that puts us in a much stronger position to build for growth. But I think there are other things that need to happen. So the public markets then sit at the top of that funding escalator or that funding ladder. And not only do the markets provide a very important form of funding, but I think they are a real magnet because no investor, whether it's a friend, a family, a fool, a venture capitalist, a business angel, will invest in the first place if they don't know what their exit is going to be ultimately. So whilst we're not trying to attract every company to the public markets, the fact that the markets exist for companies to aspire to eventually join, I think is important because therefore the markets have a pull-through effect and they provide early stage investors with an ultimate exit. But the markets, whether it's AIM or the main market, should not be seen as an exclusive form of finance, which again is why I think this panel is really important. And what we're seeing, and I've got very first-hand experience of, is that some of the companies that are now coming to market, and by the way, the good news is that companies are still coming to the market. So in the last 6 weeks, I can think of 4 or 5 homegrown UK technology businesses, from not just from around Shoreditch and Old Street, but from Sheffield, from Newcastle, from Southampton, coming to the markets and raising material amounts of capital, 7, 10, 15 million pounds. So the markets are open and they are still able to support companies. But importantly, what we are seeing is that those companies that are coming to market are saying, we're not just coming solely for equity. The fact that we've got recourse to the equity markets means that we can get our bank finance on better terms. It provides exits for early stage investors. But also, the public markets and public equity have so many additional spin-off benefits in terms of incentivizing employees, giving businesses share capital and an acquisition currency, really increasing the profile, the visibility, the credibility of companies that come to the markets. And so again, echoing Andrew Buchanan's point and the point that Michael mentioned earlier that I've quoted him a number of times as saying, we need more aspiration and we need companies and management teams to be aspiring not to sell out after 3 or 5 years, but to be forming the next FTSE 250, the next FTSE 100 business. So, where do we go from here? I think there are a number of initiatives that, as I'd say, we have welcomed to date, extensions of some of the tax breaks. We believe there is still more to be done. But I think importantly, whilst policy, and normally at events like this, the debate is about how do we reduce red tape? How do we remove barriers to entry for issuers? I think where the debate should be going is how do we broaden the base of investors that will invest and support smaller, growing and mid-cap businesses. Because I do think we are in a position where there is a bit of an obsession with reducing risk. Our markets, we don't try and operate a zero failure regime. We accept that some small companies will fail, and we believe that policymakers and regulators equally should be adopting that sort of mentality. There was a reference earlier to the US Jobs Act. My belief is actually the Jobs Act is only really curing some very specific US issues, but what it's done is it's created this impression that the US markets are open for business, and in itself it is quite aspirational. So we in Europe have been very pleased to have minor wins with things like the prospectus directive limit moving from allowing companies to offer shares to not just 100 people but 150 people without doing a prospectus. The equivalent in the US is the Jobs Act is saying let's move the limits from 500 to 2,000 people. There's a letter recently to the SEC all around the Facebook IPO, talking about actually we need to go further than 2,000 investors. We really need to get retail investors and individuals supporting our growth companies of tomorrow. And so for the policymakers in the room, my big call to action is how do we get a broader set of investors to invest in this really vital asset class? Because if they're not investing both at a pre-IPO stage and once companies on market, then the banks, the VCs, the business angels won't be wanting to co-invest. So, I think we've got some real opportunities. One of the fantastic things for me about my job is when I travel around the country, I get to meet all sorts of companies and management teams, and some of the innovation that's taking place in this country at the moment is absolutely astonishing. But it's going to be really vital for growth that those businesses don't grow and then just sell out after 3 or 5 years. So, I think we have got some amazing opportunities. The public markets are very much open and here and available and ready to support companies, but there is more that we should be doing. And alternative forms of finance, thinking about a mix of forms of finance is really important. And so I think one of my other key areas would be to say that there is still a role and a need to educate to a much greater extent. So, for instance, when we're touring around the country, we've stopped talking just about the benefits of IPO and are talking to a much greater extent about access to finance and trying to work with the banks, with the business angels, with the VCs to explain to management teams what the different alternatives are, and that one form of finance really isn't, exclusive. So I guess my other call to action would really be for people to, and particularly the intermediaries in the room, to be talking to corporates about, to a much greater extent, the different forms available and how they all sit together, so that when management teams and entrepreneurs get to the stage that they want to raise a material amount of finance, they don't find that they've closed off options earlier in their development. So, I think there are opportunities, and I think there's a lot more that we can do. there was a reference to the order book for retail bonds, and whilst we have started as the exchange very much with a focus on financials and some of the larger caps, what has been interesting about that is that I think it has captured people's imagination, and I think there is greater room for us to, once the IFAs and the other intermediaries have started to re-familiarise themselves with the concept of debt facilities and tradable bonds for corporates, to then bring that down to a much lower level where we start to see the typical size of AIM companies using the public markets for tradable bonds. So hopefully, I can see there are still a lot of long faces in the room. I'm trying to leave you with a view that actually it's not all doom and gloom. Greece isn't going to bring us all to our knees, that there are opportunities, but there's still a lot of work that collectively we need to do. Thank you.
Marcus, thank you very much. We're obviously left with the impression the markets are open, the banks, or at least Barclays, is open for business, and I think whilst you guys think of some questions, one of the things that concerns me about the introduction of things like the bond markets and the like for the smaller companies is that, and I suspect the corporates amongst us, where you've actually been negotiating bank facilities, it's amazing how many other hooks the banks put into you with regard to other products, and the extent to which your £30 million facility requires you to enter into hedging, and all your foreign exchange, etc., has to be done with them. And the moment you unbundle that and you create bonds, to what extent, and this is for you, Ross, obviously, to what extent are corporates then going to discover that there's a real cost attaching to those unbundled products?
Yeah, interesting question. I mean, we find increasingly that the pressures on bank liquidity and capital necessitate a much closer review of the broader, we would call it the business case of providing any balance sheet. The fact of the matter is that corporates' expectations of what their debt should cost versus the reality of what it costs to provide are misaligned, and as such, we bring into play competitiveness in the market, our desire to retain and develop existing client relationships. Looking at what we would term the ancillary business, which comes with any corporate lend that we make, is absolutely essential, given that on a debt-only basis, a lot of facilities would be marginally or not at all profitable, and of course that just doesn't make good business sense. So the hedging point is an interesting one. The way that we approach the business is that provision of facilities for hedging is a risk issue, not necessarily a revenue one, but of course it does add into the pot. And I think the global banking model, which Barclays very much promotes, works for the clients that we operate with. We find that we can provide better value by broadening our activities with them, and take the focus off single product streams and the returns on those, and take a more holistic relationship approach. So from the bank's perspective, it's a positive thing. We do occasionally get individuals who are not too thrilled about the prospect of having to broaden the amount of business they do with a bank in order to justify the capital commitments at the price that they want it. But on the whole, we find it's something that's relatively well received for clients, and clients are pragmatic about it. They understand the dynamic and are happy to distribute their business in order to secure the debt they need.
I think buried in there was the possibility that actually this could be cheaper, because if you're saying that the return on lending money is marginal and you make money on the other products you bundle in, if corporates go out and fund in the bond market, therefore the pricing, you would obviously be able to be more competitive on the pricing for the ancillary products.
Yeah, potentially. I mean, it works the other way around, actually.
Funny that,
the ancillary products subsidise the debt. The debt doesn't necessarily subsidise cheaper ancillary products. So if clients want to go out to the public markets and raise a USPP or a bond, then of course that is something we can help them with very happily. Okay. And that certainly adds to the business case from our side.
Okay. I'll wait for questions. Any hands going to go up? Gentleman in the middle there.
Yeah, at the risk of Mark Brady saying this is the Colin Glass show, I will ask another question.
They're all welcome.
Thanks. As I deal very heavily with SMEs, and the government and everybody else seems to think that's where the growth in the economy is going to come, isn't it about time that the banks got back to old-style relationship banking, where the bank manager actually got out there and found out what the company was doing that he was lending to or proposing to lend to, instead of having the credit team in their ivory towers working on figures and not even knowing anything about the management or the ethos of the company, and then having clever covenants whereby if you trip over, that's it, game, set and match, they come in and they can do anything. Whatever the government has said has been, in my view, completely ignored in the main by the banks, and this is having a big effect on SMEs, most of whom have now lost the incentive to try and get any funding, and therefore lost the incentive to invest going forward. There's always going to be risk in business at any level, and I appreciate that the banks don't get a big margin on their lending, but I think companies would be prepared to pay more for the money if they could get hold of it, because in many businesses the margins will support that, and there's this growth. The other area where I think they should look, and one bank is looking at this as far as I know, maybe more, is a bit more risk but a bit more reward through mezzanine lending to appropriate SMEs. So be interesting in your views there. And finally, I do agree totally with Marcus, who's always the optimist, but we do need a less regulated way of allowing people to invest in equity investments in small companies. We need to, again, there's going to be risk. People should know that if they invest in a small company, there's a chance they'll lose all the money, but on a sort of portfolio basis, they're unlikely to do that.
We will need to avoid it being a Ross bashing exercise, but so Ross, relationship,
yeah,
well, let's try that one first.
Yeah, there's several points. I thought it was probably a question for everybody else, not me actually, but there you go. So I agree. How do we as bankers get to understand our customers, their needs, and of course the risks within the business, and also find the opportunities for us to develop our business and lend money, take deposits, and broaden our activities with them. It's by going out to see them. So, I can only speak for our business. We are absolutely mandated to get out and see our customers on a regular basis. We push that internally. Our clients expect that of us, and that's what we deliver to them. So return to old school banking, I agree. There is a difference, however, between getting out to see your customers with a reasonable level of discretion and holding all that discretion yourself. And I think, somewhat, the history of banking, certainly over the last 10 years, harks back to a period where people could just come out and lend money on a handshake. And of course, I don't think any of our shareholders would want us to go out and do that. So the necessary controls have to be there. The moment that they become prohibitive to doing business and to taking reasonable decisions on providing loans to our customers is when they need to be reviewed, and that should be challenged by customers consistently as we challenge it ourselves internally. As an example, within Barclays, we take our credit officers out to see the clients. If there's a particularly contentious lend and there's something that we feel we can improve the understanding of by taking other stakeholders out to see them, then we do so. So I agree with you completely on that point. You also mentioned, clever covenants, tripping businesses up, this sort of thing. I mean, one of the issues with smaller businesses is the volatility that we see in the circumstances when we lend to them. So when we're providing term facilities, of course we need to know if something's changed. Covenants are designed to be an early warning of something changing within the business, which necessitates a review, and then we can renegotiate the facilities or change them if that's appropriate. So again, you know, designed to be customer friendly. In the SME market, we find quite often clients don't know that their business has changed. It's only the breach of a covenant or one of the internal control measures that actually brings it to their attention, so that we can take proactive action around addressing any issues that are there and potentially the management team haven't fully realised yet.
Ross, I'm going to give you a break for a second because I know John wants to.
Actually, if I could just agree with 3 points that the questioner made. I mean, firstly, it's our impression that SMEs are deterred from they are also price insensitive. They're actually, it's more about getting money. Understanding the business and the relationship of the lender to the business. Our trade finance guys actually go back to even older style banking, which is confirming house, as in the very oldest banking that used to be performed. So we will actually go out and do a deal on behalf of our customers, buy product for them and sell it for them, because they have run, because of the way the banks assess their balance sheet, they run up to their maximum on their overdraft or whatever loan agreements they have, and obviously to make a deal happen, they haven't got an invoice, they actually need pre-invoice financing, and we do that. But to do that, we actually need to understand absolutely everything about their business and the nature of that transaction, so we're very close. And that's something which I think is quite difficult for some of the larger banks to replicate now.
Now, any more questions? Because we're just about to run out of time on this session.
Ask a quick question.
As long as it's quick.
So that's another banking question. When I put money in a bank, I get 0.4% a year, and it'd be quite good if, I mean, it's no risk, because it's backed by the government in reality, but I'd be quite happy to get 4% a year, but have some risk attached. And that would allow you, if you had accounts like that, then you could take more risks with the lending, and that would open it up to the small businesses that you're not quite sure, you know, if there might be a change in circumstances. So have you ever considered a different type of bank account where you get a higher interest rate, but there is some risk attached, so you might lose some of your capital if you're unlucky? Sure.
Interesting concept. It's not something that I've thought about, because there's two issues there. One is the level of risk that our depositors would accept. Our depositors look at three things: liquidity, security and yield, and there's always a balance between those three things. The second is what return the bank actually makes in doing that, and of course, you know, banks are not institutions, despite what's happened in recent years, that look to be at the sharp end of taking risk. It's very much about putting cash out and getting it paid back. So I think you move from core bank lending into more mezzanine and more, increasingly more investor style funding. And of course, banks, I don't think would consider themselves necessarily as investors a lot of the time. We're looking for a more predictable and potentially boring return than perhaps people might like us to.
Close you down there. But now I know Tim's waiting to get on. I mean, just to say, I mean, we haven't explored some of the complications of alternative financing, but what I'm hearing, which I haven't heard for a long time, is the concept of confirming houses. Yeah. A number of other, mezzanine's been around for a long time. There is nothing new that needs to be created, but I think the point that Marcus made is we need to look at a wider pool of possible providers of funding. I do think, having made some comments about pipes at the beginning, the biggest pool of money that's sitting out there is the private equity industry. And actually, if we could have found a way of using those, or finding access to those funds more frequently within public companies and marrying those two business models, I think it would definitely help provide a bridge between the private companies and the public markets. They are a breed unto themselves, but on the other hand, they have actually, are maybe going through a slightly more difficult time at the moment. But the banks are open, the markets are open. There are pots of money around, but clearly a restricted volume of equity investment for smaller cap companies. we have to go find new sources, and there are plenty of imaginative ideas and people out there trying to pull it together. I think the key will be making sure that we're still able to communicate and find it when people have worked out where it is. So, Tim, thank you very much.
Thank you. Would you all join me in thanking the panel for that session? Okay, we've just got 2 or 3 last questions for you just to complete the set. And as I said earlier, we're going to just do a short report after the conference, which will cover the key points arising from the debates throughout the day, and will include the answers to these questions. So if we could have the next question up. And fortunately, it echoes something that Marcus said. We didn't go about 3 funding gaps, but we just said, is there a funding gap for small and mid caps at the moment? So if you hit your buzzers. Okay, and well, and we can divide that by 3, I think. That's fair enough. Okay, and the next question, will new funding options help deliver the growth Britain needs? Okay. Interesting. I think there is a clear desire for new funding options to help drive the change that we need. And lastly, ahead of our closing speaker, we're keen to find out what you think about the European Parliament and Commission. So please just take a moment to answer the following question. Is the European Parliament and Commission helping or hindering the UK's small and mid-cap companies? Now please be brutally honest here. Not that you haven't been during the course of the day anyway. Some people are still thinking about it, perhaps? No? Okay. Drum roll. Okay, so I think Dr. Kay Swinburne has a little bit of persuasion to do. I'd now like to welcome our closing speaker, Dr. Kay Swinburne, MEP for Wales, who will be speaking on Europe's role in constructing growth for small and mid